Hey everyone, welcome back to the channel. All right, so you're scrolling through stock info. You see this number, something like 28.76, and it says P/E next to it. And you're like, what even is that? And why should I care? Well, today we're going to slow it way down and break it all the way down. We're talking about the price to earnings ratio. It's one of the most talked about numbers in investing. And trust me, once you understand it, it's like unlocking a secret door into how stocks are actually valued. So let's get into it. What is the price to earnings ratio? Okay, so let's start from scratch. The price to earnings ratio, yeah, it sounds fancy, but it's really just a simple math formula. You take the price of a company's stock and you divide it by how much money that company makes per share. That's called earnings per share, or EPS. So say Apple's stock is trading at about $201 a share, and over the past year, they earned about $31 per share. You do the math. 201 divided by 31 gives you about 28.76. That's your price to earnings ratio. What it means is investors are willing to pay $28.76 for every $1 of Apple's earnings. Kind of wild, right? Why should you even care? So why does this matter? I mean, who cares what the number is? Well, turns out this little ratio tells you how much faith people have in a company's future. A high price to earnings ratio, like above 30, means folks are betting big. They think the company's going to grow fast and crush it in the future. But if it's low, like under 15, it might mean the company's kind of stuck or undervalued. But hey, context matters. A high number doesn't always mean overpriced, and a low one doesn't always mean cheap. You got to look at the full picture. Who actually uses this ratio? This number ain't just for finance nerds, all right? Everyone from beginner investors to portfolio managers uses the price to earnings ratio to make decisions. They'll use it to compare companies, like is Google more expensive than Microsoft? Or how's a tech stock looking compared to an energy company? They'll even look at how the ratios changed over time. Like Apple's price to earnings went from 19 in 2020 to almost 39 in late 2024. That's a big jump, and it tells a story. How do you calculate it again? Let's slow it down and do it one more time. 1. Find the market price of the stock. Let's say it's $201.39. 2. Now find the earnings per share. That's 31.37 for Apple. 3. Then divide it. 201.39 divided by 31.37. Boom. You get 28.76. That number tells us investors are paying almost $29 for every $1 of Apple's profits. That's what we mean when we say price to earnings. Where do you see this number in real life? You'll see the price to earnings ratio all over Yahoo Finance, Google Finance, brokerage apps, even on CNBC when they flash stock tickers. It's not just a number. It's like a pulse check on how the market feels about that company. Even the S&P 500, the big old index that tracks the US market, it has a price to earnings ratio. Sometimes it's low, like 15, sometimes crazy high, like over 100 during bubble times. Some real examples and warnings. All right, real quick, Apple's at 28.76. That tells us people are super optimistic about what's coming next. Maybe new tech, wearables, services, you name it. Now imagine a clothing store that's got a price to earnings of 8. That's super low. Could be a steal, or maybe they're struggling. You got to dig deeper. And yeah, some companies don't have earnings at all. Startups, for example. So there's no ratio. In that case, you look at other stuff like revenue growth or market share. Watch out for the limitations. I mean, don't get me wrong. The price to earnings ratio is helpful, but it's not perfect. It doesn't tell you anything about a company's debt or the economy, or if the whole industry is going downhill. Like oil companies might have low ratios, but maybe because demand's dropping worldwide, you just can't rely on it alone. It's one tool, not the whole toolbox. Final thoughts. What should you do with it? Next time you're looking at stocks, don't just buy based on hype. Check that price to earnings ratio and ask yourself, Is this number high because people expect big things? Is it low because the company's in trouble? Or is it just undervalued? How does it compare to other similar companies? When you start asking those questions, you're not just buying stocks anymore, you're making smart investment decisions. If you found this video helpful, you'll definitely want to check out my Udemy page, where I offer a range of in-depth courses on AI in accounting, finance, and business. These courses are designed to give you practical skills you can apply right away, whether you're a student, a professional, or a business owner looking to stay ahead. With hundreds of enrollments and 5-star reviews, learners from around the world are already seeing results. Click the link in the description to explore the courses and start learning today. Thanks for watching, and don't forget to like, subscribe, and share if this added value to your journey.